Just help us with this. I think everybody in this room, given the uncertainty in the world, and we're looking at bank crises or not, we had the debt ceiling that's no longer a crisis, and everything else and what the Fed may or may never do. Where do you really see us right now?
I see us as having a non-recession recession, which is always dangerous with our chief economist sitting next to me.
Is that a house view or is that a Rowan view?
I think it's a house view. I'm looking for assent there, but it's not illogical. I mean, think about how we got here. We had a financial crisis. We completely changed the rules of how financial markets worked, but none of us noticed because we printed $8 trillion. And we lowered interest rates and everything went up and to the right. Stocks went up and bonds went up and real estate went up and wine went up and cars went up. And if it could go up, it went up. Okay, we're at the end of that. Nothing along the way created excesses in the economy, created excesses in financial markets. So I look at where we are today. We're going to have, those of us who deal in financial markets are going to feel like we had a real recession. More to come. Those in
financial markets, you're going to feel a recession.
And that's what I mean by a non-recession recession. I just don't see any sign in the underlying economy of the kind of demand destruction that is going to put unemployment, back to levels we would really think about as recessionary. I mean, we were at 3.4% unemployment and people are talking about, oh my God, 4.5%. That used to be full employment like a year ago. And I think that's exactly where we are. I just see no sign of the kind of demand destruction.
Are you surprised, though, just how strong demand has been, how strong the consumer has been, and strong employment has been? And if you think you need to get inflation under control, and I don't know if you do, what kind of destruction has to happen to get there?
I just don't think we know yet. So I think the roll through of very high rates, 500 basis points move over a really short period of time is going to take time. It's going to take somewhere between 12 and 24 months to roll through the economy. It will eventually reduce inflation. Inflation seems to be rolling over in many instances anyway. But I just don't think we know at this point. But I see no sign of, yes, we're going to have a recession. We're going to have 2 quarters of negative growth, if only because inflation is going from 8 to 4. Last I looked, that's negative growth.
Do you think we get to 2?
I'd be shocked. But if we get to 2 before an election, which will keep us from getting to 2.
And what do you think to get to 2, what kind of unemployment you think you'd need to have?
I just don't know. But I just don't see us anywhere close to real demand destruction to get to what I would consider a traditional unemployment level recession. And
so given that, both in terms of the lending business that you're in and also the PE business that you're in, what are you even doing?
Look, we do what we always do, which is we're very optimistic people. Let's start with that. But we're very negative investors. We come with one strategy, which is purchase price matters. And so we assume things are going to get worse. And there are lots of reasons we can assume things will get worse, having nothing to do with the economy. Geopolitics, politics, regulatory change, technology change, cultural shifts, and everything else. The answer is we're being careful. Because we have so much instability in the underlying systems.
What I don't understand is you keep saying everything's going to get worse, but then it's not really going to be that bad.
I want to separate financial markets and the financial infrastructure from people who are employed. We have full employment in this country. We have an excess of need for labor over labor. We have restrictive, for us, immigration policies. We have an aging population. We have a period of time where our memory is it's very hard to get employees. We're very reluctant to part with employees. All of that speaks well to underlying demand from the real economy. On the other hand, we've just been through this incredible period of time where everything levitated and it's not yet at the ground.
Okay, so how far are we away from the ground and how far is the ground from us? That's both a timing and depth question.
Look, this is, I'll turn it around in a question. Take real estate. And I know there are probably lots of people in the room who have a view in real estate, but let's not argue whether real estate is good or bad or office or anything else. The typical deal done at a 5% cap rate in the last 10 years, I think cap rates have moved 300 basis points. The pure math means your equity is worth 6 cents on the dollar. That's the pure math. And if someone says, well, that's not my real estate is growing 10% a year. Okay, you're right. It's only worth 22 cents on the dollar. And so you look at the public stocks, you look at three really good real estate companies, SL Green, Vornado, and Paramount, their stocks have been decimated. You look at people's holdings of real estate and everyone's off 5 or 10%. I think we have a ways to go in terms of the correction. I think we have a ways to go in terms of growth. I think very few things other than public marks have adjusted.
Okay, well, let's talk about then, when you think about the private marks that haven't adjusted, when does that hit? Who does that hit?
I think it hits everyone. I mean, if you think about the asset classes that adjust, fixed income adjusts first because you're talking about rates and duration with very little judgment for credit. And so by and large, I think fixed income has adjusted. Traditional equity, which has lots of comparables, I think also has adjusted. I think the asset classes that have not adjusted are real assets and growth. Those are the two places where you either have unique companies that are held at unique valuations.
But effectively, you're saying that the private markets are, let's get honest, are you effectively saying everybody's mismarking their books right now?
I don't say mismarking. I say there are conventions. So for the most part, the real estate market, as an example, marks their portfolio against an index. That index is backward looking. It's called NCREIF. And on the way up, it undermarked the gains they had in their portfolio. On the way down, it's slow to mark the portfolio. Is that mismarking? No, that's the convention that everyone who is in this market understands that we do. But investors also understand that's how it's marked. So if they have opportunities to withdraw their money at higher prices than are going to be in 2 years, they're going to do that. And they're not unique. You take in the industry in which we participate, in the retirement services or the insurance industry, we look back 3 years on real estate valuations. These are conventions that were designed to smooth as opposed to, quote, made up.
Okay, so then there's a larger question, which is, you said designed to smooth. Are these the right conventions for the moment?
I don't know about right or wrong. It depends what we're trying to do. If we're looking on what's it worth on Tuesday, no. If we care what it's worth over a decade, probably.
Okay, I want to ask you about the implication for the banks in just a second, but you mentioned SL Green and Vornado and a couple of the other public companies where we've seen those stocks decimated. Do you look at that and say, okay, actually, there's value there now?
I don't look at it that way. It's not, real estate is not the strong suit of what I do or of Apollo, and you need to have a fundamental view on office because most of those declines are being driven by office. But I think we have to take stock of, I'll just say fundamentals. So I look at where we are at 9 West 57th. $110 a foot in our floor. I look at Greenwich, $114 a foot. I look at LA, $105 a foot. I look at Miami, $90 a foot. Class A office rents in Chicago, I think they start with the 2 today.
So, but talk us through then the domino effect. I think there's this expectation. I don't know if you think it's Q4. I don't think it's Q1. I don't know when you think it comes, where all of a sudden these regional banks, which have this exposure, and maybe others in the private market, I want to talk to you about that, all of a sudden actually have to mark their books. Everything gets marked in a new way. And all of a sudden we're talking about a completely different crisis.
Remember, regional banks are not equity investors in real estate. They are lenders. By and large, lenders will be okay in this cycle. That doesn't mean every lender. That doesn't mean all the time. That doesn't mean people who would need liquidity at a certain point in time. In this cycle versus the 2007, 2008, 2009 cycle, I actually think most of the pain of this cycle is going to be borne by equity rather than by debt. Regional banking is another issue. Regional banking is a mismatch of assets and liabilities. You have long-term illiquid assets, which are funded with deposits. Historically, that's been a relatively safe practice, particularly for government guaranteed deposits. But just like we had an election with full-on social media and we got a surprise, we've just had a banking crisis with full-on online banking. And guess what? $42 billion can leave a bank in 4 hours without a line. It's not a US phenomenon. This is a worldwide phenomenon.
Okay, so if that's true, and I've been spending too much time thinking about this issue, ultimately is the banking business as we know it fundamentally broken, which is to say that if the deposits really can leave that fast, there is no way, there is no plausible solution I don't see to insure those deposits unless you are going to let all of that money sit in those banks. And what that ultimately would do to the rest of the credit system in America and everywhere else and economic growth would be even worse. So What do you do?
I think about shading rather than, cataclysmic results. I know it's not as interesting, but I do think that on the margin, banks will not be as good holders of assets. But this is by design. I mean, if you think about where does credit come from? How much credit do we need? Credit is related to GDP. In 2008, the financial markets were staring into the abyss, and regulators, government, the industry made a fundamental choice. Do we allow credit to be supplied exclusively by the banking system? Or do we democratize credit and have the broad investment marketplace supply credit? Well, they made their choice. Dodd-Frank was in theory designed to restrain the market power of the four big banks. It worked. Banking is less than 20% of credit provision in the US today. And by the way, US capital markets, envy of the world. We're 50% of the world's capital. The government benefits, business benefit, consumers benefit. I just think now with this notion of banking instability, and I do mean instability on the margins, I think we will see a fundamental change in regional banking over time. I think it's Canada that has 6 or 8 banks. We have 4,000 banks. Do we need 4,000 banks? Probably not. And by the way, if you think about the economics of the business, regional banks pay more for their deposits than the big money center banks. They're now going to pay more for debt and equity, at least for a period of time. Their regulatory costs are going up. And now they know that 42 billion of deposits can leave the bank in 4 hours. So on the margin, we are going to see banks become less asset intensive and more capital markets. And by the way, debanking is happening in Europe slowly, and it's happening in Asia ever so slowly.
Okay, Mark, you know that we agree on this topic. And yet what you just said, I think for most people is considered sacrilegious in this country. The idea that you are going to effectively get rid of some of the smaller regional independent banks, community banks around the country. And so the question is, okay, let's say you do that. Is there a way then to either incentivize the big banks that are left or the private credit players that would be that'll be consolidated to actually lend in markets that would otherwise be underserved, let's say?
It's happening. I mean, eventually economics rule. I mean, I don't see us suffering from lack of credit provision right now, other than in some very isolated sectors.